All right, we're going to go over all the ways it still could go wrong, right? So there's always risk to every investment type. And we thought it'd be really appropriate to go over some of the risks involved with Heritage Square and show you more about the market, the opportunity, the occupancy, and ways that could go wrong, and also how we've mitigated these risks. I have here today Chad Olson, Director of Acquisitions with Focus Capital, who has been leading this whole deal through the acquiring phase and due diligence phase. So Chad, welcome on board here. First one here I thought we'd go over is occupancy. Right now the property is sitting at 95% occupancy, which is great in the market, right? We have other properties nearby that are higher, some are lower. Tell us some more about how this property sits right now, and maybe also how we stress test the deal to test for a break-even occupancy and why we feel good about this one here.
Yeah. So this property, as you said, is sitting about 95%, which is a really strong occupancy number in this market. And with the comp set, the comp sets are experiencing a lot lower occupancy in some cases. That's a mix of the quality of that product, the location of that product, and whether they're in lease up or not, and then the rents that they're trying to target, and where ours sits in a very affordable range. We have a pretty good amount of cushion built into that system. We're still looking to target that 95, 97, or 95 to 93% occupancy on stabilization through the whole period, but our break-even occupancy sits around 70 to 75% in any given year on average. So we have a lot of room in that to give downside protection through that whole 5-year hold period.
So you're saying essentially we've stress tested to where over the entire 5-year period of time, the property have to sit at mid to 70% range just to break even for the entire 5 years. Is that what we're underwriting? Okay. Yeah. Okay. I feel very good about that. And with the next part we're going to talk about with the starts and the supply coming online, or lack thereof rather, it's going to give you more demand. So the next piece would be, okay, so construction starts, we've got supply that's been delivered to the area quite a bit the last couple of years. There's probably some more education around, okay, what's up with the supply, what's coming online going forward, and what's planned in the future, because that could be a risk, right? There could be a risk of if there's a lot of developments coming up in the next couple of years, that could be a risk. So tell us more about where that stands.
Yeah, so the story down here for this property, why we're able to acquire it at the basis and deal level that we're able to, is the story of supply and construction that's been delivered to the market over the last handful of years. It has experienced, especially in the southern Indiana portion, a very big boom in construction, and that's kind of come to a head at this moment. And that's where we see a lot of this occupancy number that has dipped down across the portfolio, across the whole region here. You can see it across our comp set, and they're pushing for those rent levels that they need to do. This one, what they did was use concessions, use other things to get that level up. But we've kind of, like I said, come to a head of that construction has peaked and it's fallen off a cliff quite dramatically, which that's what we present, or what we believe is going to give us the opportunity to not only raise rents, but maintain occupancy at that higher level as we kind of go over that. And I'm going to take over the screen real quick and kind of show some construction reports. So MMG does a pretty good job.
I can't see your screen yet. Sorry. There we go.
MMG does a pretty good job of coming out with some different reports throughout the year. This is on the full Louisville market, so for these top line numbers, wouldn't get to. I'm going to go into the specifics of each one. But we have about 2,200 units under construction. This is a decrease or increase over last year, but units in pre-lease and lease-up phase, units planned, and prospective units has all dropped kind of dramatically over the entire market. The first thing before I get into the specific market that we're in, and I do think that it's very compartmentalized, they look at the overall MSA, but it's each region, each county, each subsection and suburb of the city and the MSA that play in their own right, because it's very different and dynamic across an entire city municipality. Absorption has been really strong in this market, and we are absorbing the units that are coming online. As you can see, that average straight through line is that 24-month average of absorption, and the last several quarters, to include January, which is a tough month to lease up, we're absorbing those units that are coming online across the market.
That's a good thing. Yeah.
There's a lot of supply coming on board. There is a lot of people willing to take those units over. We're not imbalanced by any means. And then as I kind of come down, I'm going to skip to here to kind of show where we're kind of sitting at. And this is kind of broken out, pretty easy to read graph, and I'll go to a different report that they have that kind of shows where construction starts have kind of moved in this whole thing. But we basically are dealing with Jefferson, New Albany, Sellersburg, Charlestown is the areas that kind of make up the southern Indiana portion. And in pre-lease up and lease up phase, according to MMG's research, there's 742 units across it. We're tracking most of those things. That's about 2 or 3 projects that are actually in the lease up phase. And that's in the Jeffersonville market, which is probably the more heavier one of any. And then Charlestown, we have a 204 unit project, and that probably stands alone as one. And these are the ones that have been under construction. They now are delivered. They're starting to lease up. Some of these things are reflected on our rent comp set. Then we get to under construction. We have not Shepherdsville, sorry, that's on the southwestern side of Kentucky. So Jeffersonville, we only have 264 units under construction. Charlestown, we have another 248, so 2 different individual projects most likely. And then New Albany, we have a small 83 unit project. Planned starts really dropping off a cliff. And I would put a very low probability on a lot of these projects moving forward. Planned's a little bit better. Perspective, I wouldn't put any stock into it, right? It's especially with the way the market's going, with the way rates have gone, construction costs, all of these other things that we'll talk about at length. Perspective really falls off. But there's a very small 192 unit project, 190 unit project. These two are not. They're singular projects. They're in their early planning phases. They're 1, 2, 3 years away from even getting a shovel in the ground, let alone getting into lease up. And then you can kind of see in the perspective it falls off as well. Sorry. Then I'm going to get down here. This kind of shows the construction starts and where we've moved. So for the quarters in 2021, this is all looking at Q4 2021, 2020, 21, 22, 23, and 24 today. And this is what I'm talking about with this major reversion, 60-70% drop off in construction starts that we've seen from Q4 23 down to Q4 2024. And this is going to continue.
So let's pause for a second. So why is it so important? How is that impacting our business plan and current assets already that are stabilized and built? Like, why is it so important to look at the starts that are dropping off? Like, what's that really mean for somebody who's maybe new at this kind of thing?
So those 2 things are really going to impact your occupancy levels and your rent growth levels. If there's more competition, more supply getting delivered to market, then the potential tenants have a lot more options to go look at, decide between, and then you're going to have to compete on price, like the location. Buying really good real estate is always important. I think this one stands out above the rest when being in Sellersburg because it is right next to the major grocery store there, right, and right off the highway to give you access. So the real estate, the location is already strong. But then now we have to compete on price, amenities, quality, all these other things that kind of go into it. We have larger units, larger space, townhome units, that within our unit mix, I think that goes a long way with it. But at the end of the day, it's concessions, it's rent decreases, it's occupancy decreases to maintain those rent levels. That's what these other properties across our comp set have shown is they need, because of the pricing that they're at, because of what their business plan is, that they're not willing to compromise on the rent levels, but they are willing to compromise on occupancy to their detriment. And so with this, it's giving them tailwinds, but it's also giving us tailwinds that we think we can come in there. Because at the same time, Louisville has posted, there's a chart on here, so if you look at this chart, this is showing occupancy and annual rent growth level. And you see as those major construction starts and completions, have come in, we've seen occupancy dip down. Now, it's not in any major dangerous range. We're still sitting at, a 90, between 90 and 95% occupancy, 93 on this. But rent growth has remained even through 24. And so when you average out the 4 quarters of rent growth, you're sitting at about 3.5, 3.7% rent growth, and we're only projecting 3% in our first year, let alone the follow-on years and stuff. And that's where we see the growth coming back in rent growth into 26, not necessarily 25.
So we can correlate the drop in starts with the demand for housing and rent growth going up in future years. because there's a lot of jobs coming in.
So if construction starts falling off a cliff, and this number is going to only keep coming down as we get more reports. We have units under construction, the same thing. They've really dropped off. They've really hit their plateau in Q4 of 23, let alone Q4 of 24. And then unit completions as well. Less deliveries across the market and stuff. And that is impacting the southern Indiana market that saw some of the biggest ones in the whole MSA over the last few years and is now becoming a very small portion of that entire MSA delivery. And that's kind of shown in some of this like slide here. So you have most of South Jefferson County, Portland, Shawnee. These are the areas with an East End, and then southern Indiana is at 15 and stuff. And now we're dropping down to a very small level of completions and deliveries. I think that pretty much covers on the construction parts and completions, and here on the top, the key market themes, kind of to put a pin in this to end it. Under construction inventory has decreased by 59% year over year, and driven by a nearly 70% drop in construction starts at 24. And I went and back tested that to see with the census data that usually this is driven from on completions, and then the same thing with like kind of rent growth is, and we'll get to that in like I think 2 points. But it's still very affordable by any means, especially in the Indiana side.
Okay, awesome. Yeah, thanks a lot, Chad. That's very, very informative, very helpful. And obviously, we always monitor these things with every deal we do to make sure we have the right demand for our properties going forward. Let's talk about expenses. And expenses can be one of the common ways that people can mess up if they're a rookie at this, and they can maybe forget to forecast expense increase year over year because costs go up, they don't go down. We've seen insurance and other things go up over time. Also looking at not only the seller's expenses, which were the prior year's financials, but also what our costs will be going forward. It's also important to look at, okay, what are the actual costs that we're going to have expenses on that maybe the seller wasn't accounting for because he's self-managed prior to this. So give us a couple minutes here on expenses and how and where we've mitigated risk there as well.
Yeah, so I think that we do have our expense growth, and we vary those expense growths depending on whether we're talking about general expenses, taxes, insurance, these different things, and we can kind of play around with that. We do have a sizable increase from what the seller was doing before because of that self-management, and I think that cost them in that lease up, in the rent where they're at. They're not doing proper marketing, website promotion, the payroll, the employees, all those kind of things across the board, I think cost with that lease up with where rents are sitting at now. We're going to come in and put a much more normalized expense like levels ratio into the property, and I think that maintains it. We're going to spend a lot more money on marketing and advertising to try to drive that. We've seen the success on our other properties by doing so. And then in the future thing on mitigating that risk, that yes, expense growth and getting away from you, if this was our first and only property, which it is, in that area, then you would be maybe subject to some of these expense rises from an area in a market that you're normally used to. Maybe this runs a little bit hotter on these 3 points that you're not aware of, or on the tax level. We've already gotten our third-party tax report from a qualified consultant that can give us that feedback of where those scenarios will run out. But what we need is the same thing on all the other expense line items. And so that's why we went with a professional third-party management, with PMR is who we've signed up with. They are headquartered in Louisville. Most of their portfolio that they manage third-party is in Louisville. They manage almost 10,000 units. The bulk majority of that, 30-40%, are based in Louisville and surrounding areas. And so they have already the market presence and the market knowledge about how that area operates. And we're going to benefit from the economies of scale that they bring through their maintenance and through their employees and stuff. They have a very long tenure, very good, solid reputation. So those are the things that we're going to utilize to maintain expenses in the long run and keep those under control that we would get otherwise if we brought in a first-timer down there.
Yeah, that makes sense. A lot of people sometimes will put on a pro forma with their expenses and kind of throw some darts at the wall and throw some assumptions in there. I feel like there's always risk and things costing more than you think they're going to cost. And if I'm wrong, correct me here. But what we've done here is we've really went through and got actual quotes on things. Like we've locked in an insurance quote. We've locked in a estimate from the PM company of what things will cost based on what they know in that market that they already manage properties in, to where we feel really good about the expenses here, and maybe even have a little bit of buffer built in to be able to take on some extra costs if there are some there.
Yep, on various items for sure.
Yep. So rental rates. So that is probably one of the bigger risks that people can face, or sponsors or operators can face over time, is they forecast these rents that are really too high. And you have to stretch to get there, and you hope you get there. In our past deals, we've done value add type of deals where there's a pretty large rent bump. Well, we've done pretty good at those so far, but there is a risk, right? Let's talk about this particular deal and what our rent bump is and how likely we feel like it is to achieve that, and maybe even outperform that too.
Yeah, so in general, we do not have a large, by any means, rent increase over what the current rates are. We are increasing them by about 60, 70 bucks. And that's just to market across some of the different items and whatnot. So there isn't a big rent increase by any means, and we're buying it right in the perfect time, seasonality-wise, to kind of capitalize on that with this rent growth, with the supply and everything else delivery-wise. I think across the rent comps where we sit and looking at our comp set, that's where you can kind of see it. These newer ones that are they aren't compromising on what that level is. There is definitely concessions being brought to market, but that rental rate is sitting at that level. And we, at our average, is going to be around $1,300. They're at $1,500, right? So there's a $200 delta, even though they're only a couple miles away. So we think that is extremely comfortable, extremely feasible to get to and bring it to market, and then achieve beyond that too, let alone with what rent growth and normal things kind of go with the market. All of that stuff mentioned before with construction starts and supply kind of feeds into that narrative of where this is going to spike up in about a year to 2 years, which is what we're kind of projecting, with more rent growth, with stronger occupancies. But most of those headwinds, I think, have kind of come and gone, and we're just dealing with like the remainder of the fallout from those supply things. And as I said, on kind of that bar chart, we saw about 3.5% rent growth, even with all that supply, even with all that occupancy inside of the Louisville MSA, specifically on the Indiana side. We still saw rent growth, and we should still see rent growth going into this year. And that's across the Midwest total. Indianapolis, Columbus, Kansas City, all these other markets as well in the Midwest are showing on the top of the list for Yardi Matrix, CoStar for rent growth, and Louisville's going to benefit from that too.
Awesome. Yeah, I definitely agree with that one there, man. One of the biggest risks that real estate operators face, and I've heard so many stories from old timers that have been through 3 or 4 cycles, and they say the number one risk is interest rate and the debt risk. They're like, the people that get in trouble are the ones that take on high leverage debt or take on variable rate debt and kind of get over their skis. And I've always been a big fan of being risk averse, conservative, and not doing super high leverage deals. And we've only done fixed rate debt on every deal so far. I think variable rate debt is a tool you can use in some cases. Not in that case for us today. It's not our tool belt. But on this deal, let's discuss maybe how we've really mitigated this debt risk. We've taken it off the table. We've got fixed rate debt, non-recourse loan, lower leverage loan here. Give us a couple minutes here on how our debt is structured.
Yeah, and I think we look at every debt option when we start. When we start looking at a property, we look at all the options to provide the greatest returns at the lowest risk for our investors and our team ourselves, right, in the GPP. But and most of the time right now, what's coming back is it's always this fixed rate option that ends up being the best. And sometimes we use bank debt, sometimes we use anything else, and we always want to use agency or non-recourse, right? But a lot of the times there are strict standards, which are good and definitely helpful, end up not giving us the proceeds that we need or giving us the flexibility of the business plan to execute the value add in the fact of the construction spend and CapEx spend that we need to do. With this one being a newer vintage asset, we don't have that high level of CapEx spend, so coming in with agency in the front end and through acquisition makes a lot of sense, right? And so that's where we kind of came down on in this case. And to that point, when we started this thing, we were between 60 to 65% LTV. So very
leverage,
pretty strong, very low leverage.
Yep.
And then we had a lot of cushion at the time in what rates we're at. We were playing around between a 5.85 and a 6 all-in rate, with bond yields being substantially, probably about 20, 30, 40 bips below that, basis points below that, and actual at that time when we were quoted. And so, and we always do that. And every deal that we have, we're looking for 25 plus basis points of additional spread in that initial rate until we get to a rate lock scenario, whether that's with agency, bank, bridge, whatever the case may be. And that has felt really good through this whole period. As we've gotten deeper into the process, as we've seen the rate movements happen in the bond market, just because of all the different economic news that's going on right now, we have seen that come down dramatically. And we're not to rate lock yet by any means, but there's been a lot of spread that has come down, giving us a far more favorable rates that we're initially getting quoted or seeing getting quoted. And that has allowed us to move that LTV up slightly. And so at most we'll be maxed out at 70% LTV if this all works out and comes to a head the way we want it to. And that's still a very comfortable leverage point. And at the same time that we're getting it at a very favorable rate. So the balancing act between those two things, the spread that we're going to be locked in at, is only going to enhance investor returns and provide us more peace of mind, because of having this, a very attractive rate in the context of the last year or two.
Yeah, I agree, man. I thought of two things as you were going through that. I thought of one thing was to touch on renovations, how that's not part of a business plan here, and normally that would be a big risk, as well as the cost to renovate, the timeline to renovate, to get the rent bumps. So that's removed with a Core Plus deal like this. But I thought was really cool is like that when you went through the debt piece and how we underwrite to a 25-point spread, a buffer above where the current rates are at that point in time, that really is a testament to our underwriting as how we do it conservatively, to where we want to have a buffer in there. And now it's really, we haven't rate locked yet, but it's looking really good for us because we did underwrite conservatively, and it could be a really great thing for our investors here pretty soon with cash flow and some more downside protection. Another big risk is like people pay too much for properties. Your going in basis is so important, like what you pay for it. And we've always heard like you make your money on the buy. When you buy it, that's what you make your money at. Talk to us some more about, I guess, why we feel like this is pretty low risk with the price we're getting it at a big discount to replacement costs, and why that's important.
Yeah. So I it's been highlighted definitely a lot. We see construction costs being anywhere from 160 to 180 for sticks, bricks, foundation, and up. Doesn't include land costs, soft cost, or all the fees that go into that. But just to build the building, the shell of it, and deliver that is about that 160 to 180 range, and we're going to buy this at 146 all in. And so we know that spread is a big difference. And we've seen comps in the market that have traded for 180, 190 a door. We have one under contract at 180. There's one that just got announced recently, over 200 a unit. And we've heard rumors about these other properties that are in the comp set that need to sell for 220, 230, 240. And I would say that's more in the norm. As we've seen properties trade that are newer vintage around the Indianapolis MSA, that's been kind of the going rate for a lot of these deals is about 220, 230, 240 and upwards, right? Louisville is not that much of a different market, and it's only 2 hours away. So that's where I think these things will shake out. And construction costs are, as everybody probably, we've had a big increase in the last 5-6 years through the COVID period and then now. But I think everybody can probably agree that the construction costs are not going down anytime soon. And with a lot of the recent announcements, we've read some early consulting reports and different things like that the tariffs are going to have impact. 70-80% of our softwood lumber is imported from Canada. 70% of our gypsum, so our drywall, is imported from Mexico. And all those things are going to be hit by tariffs, amongst all the other different things that come through that. We know of a lot of our different cabinets and all these other things that are imported from other countries as well. So that is going to have an impact, let alone the labor side of things, right? So there's definitely a conversation and a big question mark in the labor pool for construction workers across the country. I think the Midwest is poised for a little bit more safety and security than volatility compared to the Southeast, but that I think is a headwind that everybody's going to have to deal with, and none of these things are going to get cheaper to build. So what's going to be the solution or the outcome from that? Smaller or lower construction, I think overall, lower construction starts and completions and deliveries in various markets across the U.S. And then for those ones that get delivered, they're going to be more expensive. And so ours, in the basis that we're in and where we need to exit at, should feel pretty solid comparatively.
Yep.
And especially if we have rent growth and occupancies stay at sustained or higher levels, that'll be very strong and bullish for us as well.
I thought of two more actually. These are kind of off the cuff here. These weren't part of our bullet points here, but you mentioned tariffs. And at the time we're recording this right now, tariffs got announced a couple of days ago, and all this frenzy right now in the market. But I personally feel even better about our project because our project does not have this large renovation plan that could be impacted by tariffs. Maybe just let's go over off the cuff here, like what are some of the risks that how tariffs could affect us here?
Yeah, I like I said or highlighted in there. I don't have that little deck.
Well, you mentioned so with new developments, it could impact those for sure, and it could slow them down even further if there's more tariffs on wood and drywall, that kind of stuff. But
there won't be. I don't think there will be more tariffs. But yeah, there. Like I said, 70-80% of Canadian lumber or softwood lumber comes from Canada, and we've slapped a tariff in against what NAFTA is usually giving us and stuff, or the USMCA. And so we will see something. I mean, lumber is obviously a big input. Gypsum, drywall is a big input. I'm not exactly sure where some of our plumbing inputs come from. This consultant thing set it at kind of like a 10% increase to construction cost.
Yeah.
I can see that being aggressive and conservative at the same time. On the CapEx spend for value add projects, we could start to see stuff. So I think there's going to be a movement to find local or U.S. based, cabinet manufacturers or lighting fixtures and these other things. Not that there's many. I think most of our lighting fixture stuff comes out of South Korea and China, obviously. I know most of our cabinets and flooring come out of like a Vietnam, a Bangladesh, all these kind of countries around the world, and a lot of Asian countries and stuff. And we've seen some of the biggest tariffs added to those. And I think it's early to say what the ramifications are going to be, what kind of negotiations are going to be made, and I think that's where everybody comes down on where this is. So I think it will get worked out. The question is, how much supply did these various importers or contractors that do have their own inventory stock, how much did they bring in ahead of time to avoid the tariffs? Because I do think that there was a big move to bring stuff in anticipation of this. What's that turn time going to look like? Is it 6, 8, 12 longer weeks before that's all been burned through, and then we're going to have to bring in new stock? There's definitely the tariffs impact on some employment in America. It's not just going to affect outside countries and auto manufacturers and everything else. But it's a big question mark. But at the same time, as we were talking about, there's give and take on all this stuff. There's some big systemic issues that we need to fix, and that's what they're trying to do. And we hope that everything works out for our country and everything else.
Yep.
But with the tariffs and the announcements therein, we've seen a decrease in bond rates, and that has been favorable for this deal. And so there's negatives and positives on both sides, and the jury's still out. We just have to look at this deal, work through it, and mitigate the risk as much as possible, and take it with the good and the bad.
All right, awesome, Chad. That's been very helpful, man. We went through a lot of stuff today here on this. If you guys have any questions for us at all, you can go to our website at invest-heritage.com. You can book a call with me on there to speak with me directly. Hope it's very helpful for you guys. Thank you so much, Chad.
Thank you.